Hello, my name is Taganshi and I am from Banking Right Committee of Symbiosis School of Banking and Finance. Today, we will be covering trade finance. Trade finance represents the financial instruments and products that are used by the company to facilitate international trade and commerce. It makes easier and possible for importer and exporter to transact business through trade. It is an umbrella term used to cover financial products that brands and companies utilize to make trade feasible. Needs of trade finance. It reduces the risk associated with global trade by reconciling divergent needs of an exporter and importer. It improves cash flow and efficiency of operation by extension of credit by ensuring that there are fewer delays in payment, and it also helps in mitigating risk. It reduces the risk of financial hardship without which the company may lose on their key customers. It also helps in strengthening relationship with suppliers and improves working capital efficiency. In this video, we will be talking about letter of credit and bills of exchange. Letter of credit is an arrangement whereby a bank acting at the request of the customer undertakes to pay third party by a given date. Here, the bank acts as a guarantor for the buyer's payment to the seller, which will be on time and for the correct amount. On the event of which, if buyer is unable to pay, bank has the liability to cover full or remaining amount of purchase. Parties to the letter of credit: applicant, the buyer or the importer who arranges to be opened the letter of credit. Issuing bank is the bank which issues letter of credit. Beneficiary is the supplier or exporter in whose favor letter of credit is opened. Advisory banks advises letter of credit to beneficiary without any engagement on the part, while the confirming bank adds confirmation to the letter of credit. Let's see how letter of credit works. The importer signs a purchase contract of buying goods. He requests his bank to open letter of credit in favor of exporter. The importer bank then opens a letter of credit as per the application, and which is forwarded to the original bank and the advisory bank in the exporter's country. The advisory bank, after authenticating the credit, will forward it to the exporter. The exporter checks letter of credit and ensures that it is according to the terms and conditions, after which he ships good and prepare exports and submit it to the bank. The exporter's bank verify the documents and negotiated, while the importer, when receives the bill, checks with the document and then accepts and pay on the bill. On acceptance, he gets shipping document covering the goods purchased by him. Finally, the exporter receives payment on realization. Now, let's talk about bills of exchange. Bills of exchange is the negotiable instrument which guarantees the payment of a specific amount of money either on demand or on a set time. There is a specimen of bills of exchange attached for the reference. The bills of exchange should be in written. It should have the confirmed order to make a payment and not just a request. It should not have any additional condition. It must be signed by both drawee and drawer. The amount should be stated on the bill. Parties to the bills of exchange. There are majorly three parties to the bills of exchange. Drawer. The drawer is the maker of the bill. The bill is signed by him. Drawee is the person upon whom the bill of exchange is drawn. He is the debtor who has to pay the money to the drawer. He is known as acceptor. Pay is the person to whom payment has been made. He may be drawer himself or third party. Finally, let's see how bills of exchange work. Acceptance of bills can be general, where the drawee accepts to pay the whole amount without any condition, while under qualified, the drawee accepts to pay the bill subject to some conditions regarding the amount or the tenure of the bill. Date of maturity is the date where the bills become due on payable. It can be payable at sight, where the bill becomes due immediately after presentation, or a bill may become due after a certain period of time which is predetermined. Discounting of bill. If a holder of the bill wants to get money against the amount mentioned in the bill at an earlier date before the due date, he sells the bill to the banker or a discounting house. The latter pays cash against the bill after deducting some amount at discount charge. Endorsement of bill. It means signing on the back. For transferring his own right on the bill to some other person, the maker or the holder of the bill signs on the bill or maybe on the back of the bill or on a separate sheet which is attached with the bill. The transferor of the right is called endorser and the person to whom transfer is made is called endorser. In the next video, we will continue our discussion on trade finance. Until then, stay safe. Please like, share and comment. Thank you.